what is the damage that is done to the economy in the intervening weeks until we get that next stimulus package? And how much do you think is really needed?
Well, it's a great question. If you look at, we do the calculations on the impact fiscal policy is having across countries. And in the US case, we think fiscal policy has driven the GDP level up about 7% relative to where it would have been on a level basis. So a huge impact. And the fade, the fiscal cliff we face here is large, that you'll see a big drawdown if they don't extend the fiscal benefits that are necessary. So that's a big deal. And 500 would create a very significant cliff. So to us, our kind of estimate of what would continue to sustain the economy in the way that it's been going is somewhere in the 1.3 to 1.7 kind of range. And it depends what it's used for. There's different types of policy. The policy that gets directly spent in the economy is much more effective per dollar than the dollar that's preventing more bad things from happening. So there's a mix in this package. The money from states is going to prevent negatives. The stimulus checks will be direct positives. It's monitoring those things. And that's a good example of the challenge of trading markets and understanding economies today, because we've gone over from the last 40 years of, let's say, a more capitalist system where the monetary policy is driving the cycles and private sector entities are reacting to them. Now the biggest driver in the economy are these fiscal choices. And so many different choices are being made across countries on how to do monetary and fiscal policy. And that's having a huge impact on the differentials. So it's going to be a big deal. Now, in the short term, maybe they come up short. In the longer term, we think the basic issue is you're heading in this direction where they've learned the lesson that they're going to spend money and print money until they can't. And that's the path that they're on. And so they might come up short in this policy, but longer term, they're going to keep printing and spending until they hit the wall. The wall will be marked by inflation and currency. And so for us, I think the broader positioning should be consistent with governments printing money and spending money until you see problematic inflation, which, as the Fed has described, is significantly higher than their inflation target. So we're going to see this play out. You'll have the seesaw of politics make it more difficult, but largely you're eventually going to get spending and printing until you hit that secular turning point where that becomes too inflationary.